Assalamualaikum warahmatullahi and good morning. This is the second part of our lecture on merchandising operation. Okay, so now we will look at how do we record the transactions for the first type of inventory system, which is the perpetual inventory system. Okay. So when a company purchases items either on cash, or credit, we will record, or the company will record the purchase when the goods are received from the seller. Okay, and so when the company just ordered the item and the item has not received our place, then we do not record it as purchase yet. But when we receive the items, then we'll only recognize that as a purchase. Okay, and usually a purchase will be supplemented with a document called an invoice. So for us, the purchaser, okay, this will be considered as a purchase invoice, and the purchase invoice will be the supporting document for our recording of the purchase. But it is a sales invoice from the eyes of the seller. Okay, so they produce the invoice. So for example, here it says sales invoice used as purchase invoice by Sook Stereo. Okay, Sook Stereo is the customer. Okay, they purchased the items, and PW Audio Supply is the supplier. So they supply the items and they issue an invoice. Okay, so that invoice will be used by Sook Stereo as a purchase invoice that will be used to support the recording of the purchase transaction. Okay, so let's see. Sook Stereo received this invoice from PW Audio Supply. Okay, so Sook Stereo, which is the buyer, uses a purchase invoice from the sales invoice prepared by PW Audio Supply. So it's the same document but used differently. Okay, so Sook Stereo received an invoice from PW Audio Supply, and they will use that as a purchase invoice, and from there they will record the journal entry for that purchase. The journal entry would be on May 4. They would debit the inventory account, and they would credit the accounts payable account. Okay, so in the perpetual inventory system, whenever a company purchases some inventory, they will record it as an asset. Okay, the inventory purchase will be considered as an asset because the inventory or the asset will be giving them future benefit, because Sook Stereo will have some items that they have the potential to sell it off and gain revenue and get cash. Okay, so when they purchase the item, it is considered as an asset to them because it is promising future benefit. Okay, so we debit the inventory for 3,800, and because Sook Stereo bought the items in credit or by credit, then we credit the accounts payable, which is a liability account. Okay, on top of the purchase price or the purchase cost of the items, the buyer would sometimes also incur additional cost. One of those additional costs could be freight cost. Okay, what is freight cost? The cost of the shipping. Okay, the shipping cost. And for the shipping cost, there are some terms. Okay, FOB shipping point, and the second term is FOB destination. Okay, so in FOB shipping point, the ownership of the item transfers to the buyer at the point where the seller gives out the item to the shipping company. Okay, at that point, the according to the terms, at that point the product or the item is under the ownership, or it has already transferred to the ownership of the buyer. Okay, so with this kind of term, the FOB shipping point, the freight cost, the cost of shipping is borne by the buyer. The buyer needs to take up the cost of the shipping. Okay, so ownership of the goods passes to buyer when the public carrier accepts the goods from the seller. Okay, in the second term, FOB destination, the ownership of the item transfers to the buyer at the point where the shipping arrives at the buyer's place. Okay, so because of that, the cost of the shipping is borne by the seller. Okay, so we need to understand for every purchase or every sale that happens, what is the term of the FOB. FOB is short for free on board. Okay, so when is the transfer of ownership of the item is done, whether it's at the seller's place or whether it's at the buyer's place. So if the transfer of ownership happens at the seller's place, then the buyer should bear the cost of the shipping. But if the ownership transfer happens at the buyer's place, then the seller should bear the shipping cost. Okay, let's see some illustration here. This is the first illustration, and assume upon the delivery of the goods on May 6, Soak Stereo pays Public Freight Company $150 for freight charges. Okay, so in the first case, the cost of the shipping is borne by Soak Stereo. Therefore, Soak Stereo should be the one that will be recording the freight charges in their accounts. Okay, so the record or the general entry will be debit to inventory $150 and credit cash, assuming that they pay the shipping by cash, they will credit cash by $150. So why do we debit inventory by $150? Because freight charges is a cost that needs to be borne by Soak Stereo in order to bring the inventory to their place. Okay, so it is part of the inventory cost. So the cost of the freight is inserted into the inventory, or is embedded into the cost of inventory. Okay, because it is part of the cost of getting the inventory to the warehouse of the seller. Okay, the premise of the seller. Okay, this is in the first case. So in the second case, if the freight item is borne by the seller, okay, then in the seller's books, they should debit their freight out. Okay, freight out is an expense, so they should debit freight out account, and they should credit cash by $150. So freight out account is an expense account. So this is in the case where the freight is borne by the supplier. So these are the journal entry that should be made by the supplier, and on top here, that's the journal entry that should be done by Soak Stereo, the buyer, if the shipping cost is borne by them. Besides freight costs, there are some other issues that the purchaser might come into. Okay, the purchaser might be dissatisfied because the goods are damaged or defective, or have an inferior quality, or do not meet specifications. Okay, so the buyer have the opportunity to return the items and probably gain back credit or get back cash. Okay, so there are two types here. One is purchase return, and the other is purchase allowance. So in purchase return, the purchaser, the buyer, returns the goods for credit if the sale was made on credit, or for a cash refund if the purchase was made for cash. Okay, so if the purchaser bought the items in cash and they return the items because of defect or inferior quality, then they will get back cash. But if they purchase the item by credit, then and return the items, then they will get a credit refund in terms of credit. Okay. The other type is the purchase allowance. If somehow the seller allows that the purchaser keep the items, but reduce the purchase price. Okay, so that is called purchase allowance. So assume Sook Stereo returned some goods costing 300 to the supplier. Okay, so in Sook Stereo's account, they will deduct from the accounts payable by 300. They will debit the accounts payable, meaning that they will reduce the owing amount by 300, and they would credit inventory 300 because they have returned the items. Therefore, they no longer have the items, so they need to reduce their inventory level by debiting $300.